Welcome to Quiet Learning. In this video, we're going to quietly explore what really happens when you pay with a credit card. What feels like a simple tap or swipe is actually a carefully coordinated process involving banks, networks, computers, and security systems working together across the world. There are no alarms, no flashing lights, just silent calculations, encrypted messages, and a steady flow of trust moving between systems. Over the next few minutes, we'll follow a payment from the moment you use your card through authorization, settlement, and final posting on your statement. Let's begin. When you tap, insert, or swipe a credit card, the action feels simple. A small sound, a green light, and the transaction is complete. Yet behind this moment is one of the most complex and reliable financial systems ever built. In just a few seconds, information travels through encrypted networks across banks, processors, and global payment systems, all working together to verify your identity, approve the purchase, and prepare the movement of funds. This video will quietly and carefully walk through each stage of that process, from the instant your card touches the terminal to the moment money settles into the merchant's account. We will explore how data is protected, how fraud is detected, how banks communicate, and how timing, risk, and regulation shape every transaction. The goal is not speed, but understanding, a calm journey through the hidden systems that support everyday payments. The process begins when the payment terminal reads your card. This can happen through three main methods: magnetic stripe, EMV chip, or contactless NFC. Each method uses a different way to transmit information, but all provide the terminal with enough data to start the transaction. Magnetic stripe cards store static data, which is read directly from the stripe. EMV chip cards contain a small computer chip that generates dynamic, one-time cryptographic values for each transaction. Contactless cards and phones use near-field communication, which transmits encrypted data over a very short distance, usually less than a few centimeters. The terminal collects essential fields, such as the card number or token, expiration date, transaction amount, merchant ID, terminal ID, and timestamp. In modern systems, the real card number is often replaced immediately with a token, which represents the card but has no usable value outside the transaction system. This data is formatted according to payment standards, such as ISO 8583 or ISO 2022, and prepared for secure transmission. Before anything leaves the terminal, encryption is applied to protect the information from interception. Payment terminals are designed to be tamper-resistant. If someone attempts to open or alter the device, it can automatically erase sensitive data and disable itself. This physical security is paired with strong digital encryption. When the transaction data is captured, it is encrypted using symmetric or asymmetric cryptographic keys stored securely within the terminal's hardware security module. These keys are managed through a key injection process that ensures no one, not even the merchant, can access them directly. End-to-end encryption means the data is unreadable from the moment it leaves the terminal until it reaches the payment processor or secure decryption point. Even if intercepted, the data appears as random noise. In contactless and chip transactions, the card itself generates a cryptographic code called a dynamic cryptogram. This code is unique to that transaction and cannot be reused. This prevents replay attacks and makes card cloning far more difficult than with older magnetic stripe systems. Once encrypted, the terminal sends the transaction request to the merchant's payment processor using secure communication protocols over wired or wireless networks. The payment processor acts as the merchant's technical gateway to the banking system. It receives encrypted transaction requests from thousands of terminals, validates the format, and ensures the data complies with network rules. The processor checks that the merchant account is active, that the terminal is authorized, and that the transaction data is complete and valid. It may also perform preliminary fraud screening, such as checking for unusually large amounts, duplicate transactions, or mismatched location data. Once validated, the processor determines which card network the transaction should be routed through. This is based on the card's brand and number range, known as the Bank Identification Number or BIN. The processor then packages the transaction according to the specific messaging requirements of the chosen network and forwards it along. Throughout this process, the processor logs the transaction, timestamps each stage, and prepares for later reconciliation and settlement. Card networks such as Visa, MasterCard, and American Express operate massive global communication systems that connect processors, issuing banks, and acquiring banks. They define the technical standards, security requirements, and business rules that govern transactions. When a transaction enters the network, it is routed to the issuing bank using the card number or token. The network ensures the message arrives quickly, reliably, and securely, often across international borders and time zones. Networks also perform real-time risk scoring, looking at patterns across millions of transactions. They may flag transactions that match known fraud trends or that appear statistically unusual. In addition to routing and security, networks manage interchange rules, chargeback processes, and dispute resolution frameworks. They act as neutral intermediaries, ensuring that all participants follow consistent rules and that funds move correctly between institutions. Once the transaction reaches the issuing bank, the bank takes full responsibility for deciding whether to approve or decline the request. The issuing bank is the financial institution that issued the customer's credit card and manages their account. When the bank receives the transaction request, it begins a multi-step evaluation process that usually completes in milliseconds. First, the bank verifies that the card is valid, active, and not reported lost or stolen. It checks that the card number, expiration date, and security codes match its records. Next, it evaluates the available credit limit. If the transaction amount exceeds the remaining credit, the bank will decline the transaction. Simultaneously, the bank runs the transaction through its fraud detection systems. These systems use machine learning models trained on historical transaction data. They assess factors such as transaction amount, merchant type, location, time of day, device fingerprint, and recent spending behavior. If the risk score exceeds a certain threshold, the bank may decline the transaction or request additional authentication, such as a one-time code sent to the customer's phone. If all checks pass, the bank generates an authorization approval code and reserves the transaction amount against the customer's available credit. This reduces the customer's available balance, but does not yet move any money. Once the issuing bank makes a decision, it sends an authorization response back through the card network to the payment processor and then to the merchant's terminal. The response includes an approval or decline code, a reason code if declined, and sometimes additional data such as partial approvals or prompts for customer verification. From the customer's perspective, this entire exchange appears as a brief pause followed by a confirmation sound or message. What feels like a simple tap is actually the result of multiple encrypted communications across several institutions. If the transaction is approved, the merchant is authorized to provide the goods or services. If declined, the merchant may ask for another form of payment. At this stage, the transaction is authorized but not yet settled. The funds are reserved but still belong to the issuing bank. The actual movement of money happens later during the clearing and settlement phase. Throughout the day, the merchant's terminal or point-of-sale system stores all approved transactions in a batch file. This batch typically includes transaction details such as amount, card type, authorization code, and timestamp. At the end of the business day, or at scheduled intervals, the merchant submits the batch to the payment processor. This process is called clearing. The processor validates the batch, checks for duplicates or errors, and formats the transactions for submission to the appropriate card networks. Each network may have specific file formats, timing requirements, and cutoff times. Once submitted, the networks distribute the cleared transactions to the issuing banks. At this point, the banks know the final amounts they owe to acquiring banks and begin preparing the transfer of funds. Clearing ensures that all parties agree on the transaction details and that there is a shared record of what was authorized and what will be settled. Settlement is the process by which money actually moves from the issuing bank to the acquiring bank. This typically occurs 1 to 3 business days after the transaction, depending on the payment network and banking systems involved. The card network calculates the net amounts owed between institutions. Rather than transferring money for each individual transaction, banks often settle in batches, reducing the number of transfers required. The issuing bank sends funds to the acquiring bank, often through central banking systems or clearinghouses. The acquiring bank then deposits the funds into the merchant's account, minus processing fees. These fees include interchange fees paid to the issuing bank, network fees paid to the card network, and processor fees paid to the payment processor. The exact structure of these fees varies based on card type, transaction type, industry, and risk profile. Once the funds appear in the merchant's account, the transaction is complete from the merchant's financial perspective. On the customer's side, the transaction initially appears as a pending charge on their credit card account. This reflects the authorization hold placed by the issuing bank. After settlement, the transaction becomes a posted charge. It is included in the account balance and will appear on the next billing statement. If the customer returns the item or the merchant issues a refund, a new transaction is processed in the opposite direction. The refund follows a similar path through the processor, network, and issuing bank, eventually reducing the customer's balance. Chargebacks occur when a customer disputes a transaction. In this case, the issuing bank temporarily credits the customer's account and requests evidence from the merchant. The card network manages the dispute process according to strict timelines and rules. These post-transaction processes ensure that errors, fraud, and misunderstandings can be resolved in a structured and fair way. Fraud prevention operates at multiple layers of the payment ecosystem. The terminal, processor, network, and issuing bank all contribute to detecting and preventing unauthorized transactions. At the terminal level, chip and contactless technology use dynamic cryptograms that prevent card cloning. At the processor level, transaction patterns are analyzed for anomalies, such as repeated declines, unusual spending amounts, or mismatched geolocation data. Card networks monitor global transaction flows and identify emerging fraud trends. They update security rules and share risk intelligence with banks and processors. Issuing banks use machine learning models that continuously learn from confirmed fraud cases. These models adapt to new patterns, such as account takeover attempts, card-not-present fraud, and synthetic identity fraud. Customers also play a role through transaction alerts, biometric authentication, and account monitoring tools. Together, these layers form a distributed security system designed to minimize fraud while preserving convenience. Tokenization replaces the actual card number with a unique random token that represents the card in a specific context. This token can only be used by the authorized merchant or device and cannot be reverse engineered to reveal the original card number. Digital wallets such as Apple or Google Pay use tokenization extensively. When a card is added to a wallet, the card network and issuing bank generate a device-specific token and store it securely in the device's secure element. When a payment is made, the wallet sends the token and a dynamic cryptogram instead of the real card number. This means the merchant never sees the actual card details, reducing the risk of data breaches. Tokenization also enables recurring payments and subscriptions to continue securely, even if the physical card is replaced. The token can be updated behind the scenes without requiring the customer to re-enter their card information. Online and card-not-present transactions involve additional risks because the physical card is not present at the point of sale. To address this, extra authentication layers are often used. One such system is 3D Secure, sometimes branded as Verified by Visa or MasterCard Secure Code. This system adds an authentication step during checkout, such as a one-time passcode, biometric confirmation, or banking app approval. The authentication request is sent from the merchant to the issuing bank through the card network. If the customer successfully authenticates, the bank assumes greater liability for fraud, shifting risk away from the merchant. Other online security measures include address verification systems, card verification values, device fingerprinting, and behavioral analytics. These tools assess whether the transaction appears consistent with the customer's normal behavior. Together, these systems help balance security and convenience in environments where physical card verification is not possible. When a transaction occurs in a different currency from the cardholder's account, additional processing steps are required. The transaction amount is converted using an exchange rate set by the card network or issuing bank. The exchange rate typically reflects wholesale market rates plus a small margin. Some issuing banks also apply a foreign transaction fee, which is added to the converted amount. The authentication process remains largely the same, but the issuing bank evaluates the transaction using the converted amount and applicable fees. Settlement may involve cross-border banking systems and additional regulatory checks, such as anti-money laundering screening and sanctions filtering. Despite these complexities, international card transactions usually complete within the same timeframes as domestic ones, demonstrating the efficiency and reach of global payment networks. The payment ecosystem operates within a framework of regulations designed to protect consumers, ensure financial stability, and prevent financial crime. Payment Card Industry Data Security Standards, or PCI DSS, define how card data must be stored, processed, and transmitted. Merchants, processors, and service providers must comply with these standards to handle card payments. Banks are subject to regulations related to consumer protection, fraud prevention, anti-money laundering, and data privacy. These regulations vary by country, but share common goals of transparency and security. Card networks enforce their own rules and compliance programs, auditing participants and imposing penalties for violations. This ensures consistency across the global system. Together, regulatory oversight and industry standards create a structured environment in which trust can be maintained across billions of transactions each year. Payment systems are designed with high levels of redundancy and fault tolerance. Multiple data centers, communication paths, and backup systems ensure that transactions can continue even during hardware failures, network outages, or natural disasters. Processors and networks operate in active-active configurations, meaning multiple systems run simultaneously and can take over instantly if one fails. Transactions are logged at multiple points in the system, allowing for reconciliation and recovery if messages are delayed or lost. This resilience is one reason card payments are available almost everywhere, almost all the time. The system is built not just for speed, but for reliability and continuity. Every card transaction involves the distribution of fees among participants. Interchange fees compensate issuing banks for credit risk, fraud protection, and account management. Network fees support the operation of global payment infrastructure. Processor fees cover transaction handling, security, and merchant services. Merchants often negotiate rates based on transaction volume, industry type, and risk profile. High-risk industries may pay higher fees due to increased fraud or chargeback rates. While fees represent a cost to merchants, card payments also reduce cash handling risks, increase sales convenience, and enable online commerce, which can outweigh the expense. Understanding these economics helps explain why card acceptance is nearly universal despite the costs involved. Payment systems continue to evolve. Biometric authentication, real-time payments, blockchain-based settlement, and open banking interfaces are shaping the future of financial transactions. Some systems aim to enable instant settlement, reducing the delay between authorization and fund transfer. Others focus on increasing security, reducing fraud, or improving accessibility. Despite these changes, the core principles remain the same: secure data transmission, trusted intermediaries, risk management, and reliable settlement. Future systems will likely integrate with existing card networks rather than replace them, building on decades of infrastructure and trust. To summarize, a card payment begins with data capture at the terminal, followed by encryption and transmission to a payment processor. The processor routes the transaction through a card network to the issuing bank. The issuing bank authorizes or declines the transaction based on account status, available credit, and fraud risk. The response travels back through the network and processor to the terminal. Later, transactions are batched, cleared, and settled. Funds move from issuing banks to acquiring banks and finally to merchants. Throughout the process, multiple layers of security, compliance, and redundancy ensure accuracy, safety, and reliability. What appears to be a simple tap is actually a carefully coordinated sequence of events involving advanced cryptography, global networks, regulatory frameworks, and financial risk management. This has been a quiet learning explanation of how credit card payments work. The next time you make a payment, you can pause for a moment and remember the quiet systems working behind the scenes. Each transaction represents a collaboration between technology, mathematics, banking, and trust. These systems do not seek attention. They operate silently, consistently, and reliably, supporting everyday life without interruption. From a small cafe purchase to a global online order, the same invisible pathways are at work. Thank you for taking this calm journey through the world of card payments. If you'd like more quiet explorations of the systems that shape daily life, you're welcome to stay and listen.